When you're doing your tax planning in retirement, what tax rates are you going to be subject to? Actually, 3 different types. I'm going to lay those out. That and more coming up. My name's Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. There's 6 areas to your financial life. Most people just view investments, and most financial advisors just view investments, and it's all about investment strategy. It's wildly important. However, you're missing 5 other critical components of your financial life, and guess what? They're all connected. And in order to make great financial decisions, you've got to look at your financial life in a comprehensive way. All 6 areas, sort of how they work together, and are they working in synergy? And that's why we're going to say you need to work with a CFP that's doing comprehensive financial planning, not just focused on one area. If they're just focused on one area, then you've got to look at the other areas. Or if you, and this is often the case, I've got a financial advisor that helps me with investments, I've got a CPA that does my taxes, I've got an insurance agent that helps me get my home and auto insurance in place, I've got my attorney, and each of those individuals or each of those areas have their own respective goals or agendas, and they might be clashing with each other. Okay, I'll get off my soapbox here, but that's sort of the lead into when you're planning for retirement. Oftentimes you're focused on, do I have enough saved up, and how am I going to optimize Social Security, and what are my streams of income, and all that sort of stuff. That's extremely important. We help people with all of that. However, you've got to be very, very aware of your tax planning in retirement. Most people think, well, while I'm working, that's when I need to be aware of taxes, and should I be contributing pre-tax or Roth? Should I do any Roth conversions? That's when I really care about my tax picture. When I'm in retirement, that's just easy. Absolutely not. You actually have more variation and more control in your tax picture in retirement than you do while you're working. You need to be very proactive with your tax situation, and tax planning is all about being proactive. Tax preparation is reactive, getting the right numbers in the right box. What was the result? Tax planning is being proactive. What should I do? What could I do differently to improve my tax picture and help me pay the least amount of tax over my lifetime? Well, when you're doing tax planning in retirement, you need to be aware of the various tax rates that you could be subject to, and there's actually a couple. Most people think, well, it's just, it's just regular. No, it's not. It's actually, there's, depending on the type of income you have, could subject you to different types of tax rates. The first one is the obvious one, okay, and that's ordinary income tax rates. And what taxes will, or what income sources will be subject to ordinary income tax? IRA withdrawals, that's the obvious one, maybe pension, something like that, interest income as well. And so ordinary income or ordinary income tax rates, that's you add up all of your income, the income that's subject to ordinary income taxes, so your IRA distributions, your pensions, your interest income, those sorts of things. Subtract out any deductions that you have, and in retirement, most of you will be subject to a standard deduction. That will be the most beneficial. Most people aren't itemizing these days anyway. And so you add up all those income sources, subtract out your standard deduction, and then your ordinary, the remaining amount is taxed at ordinary income tax brackets at tax rates, which is the first X amount. So if you're married, call it around $22,000, is going to be taxed at 10%. From 22 to just under 90,000 is taxed at 12%, and then above 90 and on up to around 178 and 180 in that range is going to be at 22% tax bracket, and then it continues to escalate from there, 22 to 24 and beyond. So those are ordinary income tax rates. Whether you're married or single, those are the same tax brackets, 10%, 12%, 22%, and so on. Right now, and I've done some videos on these here on this channel, that's set to sunset and revert back to the old tax brackets and old tax rates out there in 2026. So we'll see, but that's ordinary income. Now, the second tax rate you might be subject to in retirement is capital gains rates, capital gains tax rates. Now, what income is subject to capital gains rates? Well, investment income that is held long-term, and investment income that is derived from qualified dividends. Okay, now that's getting a little granular. So might not make sense to all of you, but work with your certified financial planner. If you have investments, stocks, bonds, those sorts of things that are held outside of tax sheltered accounts, so not within an IRA, not within a Roth IRA, something like that, just in a joint account or an individual account, then as those investments grow, if you sell any of those investments and there was appreciation, there was growth, if you held that investment for less than 12 months, then that growth is a short-term capital gain. That's also going to be subject to ordinary income taxes, like I mentioned earlier. But if you held that investment for more than 12 months, then that growth is subject to long-term capital gains rates. And the great news is long-term capital gains rates, because our tax system is progressive, meaning they try to manipulate your behavior. That's how I would define that. They want to encourage investment, not discourage it. And I completely agree. I see taxes as a speed bump personally. I know that, they go to many good things that we need, but they feel more like a penalty to me. And therefore, thankfully, that the capital gains rates encourage investment and don't discourage it, okay? So your capital gains rate, that long-term capital gains rate, if your ordinary income tax rate is in the 0 or 10 or 12% tax bracket, your capital gains rate is 0% federal. That's fantastic. That income could still be subject to state tax rates if you live and are subject to a state tax rate, but 0% capital gains rate. If you are in the 22% tax bracket or higher, then your capital gains rate is 15%. And then out there around $500,000 or more, that capital gains rate jumps again just a little bit as well. But most of us are going to be subject to 0% capital gains. That's where you'd want to do some capital gain harvesting, or a 15% capital gains rate. Same scenario, if you hold investments outside of those tax shelters, outside of your IRA, outside of your Roth IRA, and those investments pay a dividend, okay, pay a dividend, then if those investments meet certain criteria, then those dividends could be considered qualified dividends. Not going to go through all of that here. The majority of dividends are qualified dividends, but not all. And if it's a qualified dividend, then that income, that dividend income, will also be taxed at capital gains rates, long-term capital gains rates. So that 0% or 15%. Any dividends that are considered non-qualified would be subject to ordinary income tax rates. So in retirement, you've got your ordinary income and ordinary income tax rates. Then you could potentially have capital gains and capital gain rates. And then the third income tax that you may be subject to in retirement is something you might not normally think of. And I would call it income-related monthly adjustment amount. That we affectionately call IRMA, okay? And you want to avoid IRMA. But IRMA, I would classify into an additional tax that you could be subject to in retirement. And yeah, you could be subject to additional taxes when you're working as well. But I would put them in a separate category, because IRMA is where you pay an increased amount for your Medicare Part B or Part D. And by the way, if you're doing Medicare Advantage or Medicare Part C, you're going to be subject to this anyway because you pay the Part B amount. And so that is, if your income, your modified adjusted gross income from the prior year, 2 years ago, if your income's above certain thresholds, then all of a sudden, when you get your Social Security kind of statement or summary for the upcoming year in November, they're going to tell you your Medicare premium, instead of being this, will be this. You're going to have to pay a surcharge, a higher amount. That surcharge is called income-related monthly adjustment amount. Not because you're going to get a better Medicare Part B plan or Part D plan. Not because you're going to get special treatment at the doctor even though you're paying more. It's because your income was high. Your income was higher for the prior year. Guys, there's no way around it. That is an additional tax. This is an additional tax if you're subject to IRMA. Now, we've served lots of folks, and some are going to be subject to IRMA just because of their financial situation. They've got a lot of income, they've got a lot of resources, and we can do all the tax planning possible to limit it and minimize it, but you're still going to be subject to it. And if that's you, I would strongly encourage you to do the comprehensive financial planning to limit and minimize it as much as possible. Other times, you're going to be subject to it because of a lack of planning. a lack of comprehensive planning because you weren't aware that if you did that extra withdrawal or if you did that much in Roth conversion, now you're going to have to pay a higher amount for your Medicare Part B and Part D 2 years from now. So the third classification of taxes out there in retirement is additional taxes. I would call it IRMA. Now you could have to pay a net investment income tax, but that one's going to be added to your 1040 and all that sort of stuff. So yes, there could be more that you're going to want to do comprehensive financial planning, work with your CPA and financial planner about, but specifically IRMA is the one that you want to avoid. So what's your retirement income game plan? And are you being proactive with your tax situation so that you can minimize the income that's taxed at ordinary tax brackets and increase your deductions via either doing Roth conversions out there in the future or managing your withdrawals, doing qualified charitable distributions, those sorts of things? Are you doing tax loss harvesting, tax capital gain harvesting? Are you maximizing your capital gains, long-term capital gains rates? Are you maximizing those? And are you doing everything possible to avoid and limit IRMA, income-related monthly adjustment amount? You've got to be aware of how your financial situation impacts those and do that proactive planning to manage those taxes. Work with your certified financial planner on that. Make sure that CFP is doing comprehensive financial planning and working and collaborating with your CPA. If you don't have a CFP on your team that's doing that, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well. Or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.